Hey everyone, Kirk here with Tactical Options Trading. Thank you so much for joining me on this video. So today I wanted to make a video for you on candlestick patterns and how we use candlestick patterns in our trading. So candlesticks have been around for a very long time. In fact, they've been around since about the 16th century when Japanese rice traders used to use them when trading their rice contracts. So when we're talking about candlesticks, there's really only two types. There's bullish candlesticks and bearish candlesticks. And let's talk about the difference. And then later on in the video, we'll talk about putting these two candlesticks together to form patterns that we as traders can get an idea of market bias or market sentiment. So a candlestick is basically pointing out 4 price points in the market. And let's dissect it. Let's look here at the candlestick on the left. So what is this candlestick telling us? So this candlestick is pointing out 4 price points. We have the high of the day, we have the low of the day, we have the open, and the close. So let's say we're looking at this candlestick on a daily chart. This candlestick would represent 1 day's worth of price action. Now let's say we're looking at this candlestick on a 5-minute chart. This candlestick would represent 5 minutes worth of information or trading. So this kind of gives us an idea of the price action in that time frame that we're looking at. So what makes a bullish candlestick? So when we're looking at a bullish candlestick, we have the open and the close, and that close is higher than the open. That's basically all it is. That makes a bullish candlestick. So anytime that close is higher than the open, that candlestick is a bullish candlestick. Now what's represented here by these wicks? Well, these wicks represent the range that this candle has traded in throughout the day. So after that stock opened, or that candle opened, it traded in this range throughout the day. It could have came all the way up and then all the way down and all the way up, but at the point of close, it closed at this point, which was higher than the open. So that candlestick became a bullish candlestick because price actually closed higher than where it opened. Now let's take a look at the bearish candlestick, which is just the opposite of a bullish candlestick. We still have the high, we still have the low, and we have the open and the close. Again, we have the range of the candle, but because of that close was lower than the open, this becomes a bearish candlestick. Now I want to point out that the range between the open and the close is called the body of the candle. So let's take a look at some of these candlesticks in the market and how we can put these two together to form patterns and give us an idea of market sentiment. So let's take a look first at bullish candlestick patterns. So what you're looking at here is a bullish engulfing pattern. So when we're talking about bullish patterns, we're looking for that stock to come into support and then turn around and rally. So we're coming into the bottom of a downtrend, and we're looking for that support to hold, and we're looking for some indication that that support will hold and trade to that upside. So what we have going on here is here's our support, and in this first candle here, of course, we have the open at this point and the close at this point. So we know that this day the price action was lower, but on that second day comes in and it's a very wide price action day. So we opened up at this point and we closed at this point, and now you can notice that on this pattern that this bullish candle completely engulfed the day before. So all the sellers that sold the stock this day and were selling it short, all of a sudden these buyers come in and completely engulf all those sellers. So this is a good indication of a market reversal, especially when we tie it in with market support. Let's take a look at what that actually looks like on a stock chart. So you can see here, it's a random stock chart. Again, we're coming into that support level right here. And this candle here was a down day. We have the close lower than the open. But on that next day, we have that wide range candle that completely completely engulfs the range of that previous day's candle. And we can see that that stock did turn around and did start to trade higher that day. Now let's take a look at another bullish pattern. This is called a bullish harami. So when you see this pattern, the first thing that comes to mind is that the momentum preceding it has stopped. So on the first day, you see a wide range candle that closes near the bottom of the range. So the sellers are still in control of this stock. But on that second day, there's only a narrow range candle that closes up for the day. So what we look at in this pattern is that momentum to the downside has stopped. We have some buying that has come into the market, and we're right there near that support level. And so we're looking for that support level to hold. So the stock actually gapped up. So we closed at this point. Now remember, on a bearish candle, we opened up here, we closed here. So if this market were to continue down, we might want to see another candle basically opening at this point and closing lower. But because this candle actually gapped up and it opened up higher and then actually even closed higher than that, it gives the sellers reason to pause. So tied in with this support, it's a good indication of a market reversal, and we might want to look for other indications too. But that gives us an idea that the momentum to the downside has actually stopped. Now let's take a look at what that looks like on a stock chart. So you can see we have a bearish harami here. We're coming into that support level again. We're looking for that support level to hold. And we actually have a big down day candle. And then that second day, we have a bullish candle, which causes the sellers to pause for a moment. In fact, right after we get this bullish harami here, we have a bullish engulfing pattern. You can see that green candle there is completely engulfed the previous day's candle. Let's take a look now at another bullish reversal pattern. So this is a hammer candlestick. So what's going on in a hammer candlestick pattern? So again, we're coming into that support level here, and we're looking for confirmation that that support level is going to hold. So when we look at the price action of a hammer candlestick, we can see that we actually opened up at this point, and because that's a green candle, we can tell that we closed higher. So at some point in the day, the sellers were in control of this stock and they drove that stock down. But when it got down here to this point, the buyers said, nope, we're not going to let that happen, and they drove that stock all the way back up to this point. So we actually closed higher on the day. And what happens a lot of times when you're coming into support and you see these hammers is that there's say that a buyer was looking for this support, and they went ahead and bought stock at this point, hoping that that stock would bounce off this support and continue higher. And when they bought that stock, they would set their stop loss orders below the support levels here. So we have quite a few stop loss orders sitting below support. So what happens is when that stock starts to trade down, all those people who had bought stock are now having their stop losses triggered, and so it ends up their stop loss triggers and continues to sell all the way down here and trigger those stop losses. Now the professional traders know that this is going to happen, and they actually end up coming in and buying that stock at this point, and they get a good deal on that stock, and that stock then trades higher. So when you see these hammers, we might not want to use that hammer alone as indication of a reversal, but it's a good indication that maybe there could be a reversal coming, so we could look for other indicators to help us to know if that support level is going to hold or not. So let's look at it here on a stock chart. So you can see we have a support level of some sorts here, and we're looking for a reversal, and you can see that hammer pattern here gives us an idea that this stock could reverse. Now we might want to use other indicators to let us know that that stock's going to reverse, but this gives us a good indication, and you can see that after we had that hammer, that stock did continue to trade up. Let's look at another bullish reversal pattern called the piercing line. So this is a two candle reversal pattern like the others that we've seen, where on the first day you see a wide range candle that closes near the bottom of the range. So the sellers are in control at this point, but on that second day you see a wide range candle that has a close that's above the midway point of the previous candle. So those that shorted the stock at this point and were looking for that stock to continue down are probably a little bit nervous at this point, as the stock is now turning against them, and so they're going to have to buy their positions back to get out of the stock, which could just continue to drive that stock up. So these are when these happen, these can be very, very powerful setups. So let's take a look at what that looks like in the actual on a stock chart. So you can see here's a piercing line. So we had that previous down day candle followed by a piercing line up day, and we can see that up day closed above the midway point of that previous day. And then you can see we have that support level here, and we were looking for it at that support level. It's interesting to note here that as we come into that support level, we did have a bullish harami indicated by this small candle trading inside the body of this larger candle, and then we traded up based on this piercing line. We traded up, and then we come down to that support level again, and look what we have here. We have a hammer. So this support level is giving us all kind of indication that that's going to hold and do well for us. So now let's take a look at some bearish reversal patterns. So when we're talking about bearish reversal patterns, it's the exact opposite, but it's just going to be to the downside. So let's take a look at a bearish harami. So again, as in the bullish harami, we can see that the momentum has stopped to the upside, and we're coming into a resistance level. So on the first day, you see a wide range candle that closes near the top of the range, and the buyers are still in control of this stock. But on that second day, there's only a narrow range candle that closes down for the day. So this gives us a reason to pause as a buyer and start maybe looking for that downside action. Let's take a look at what that looks like in a stock chart. So you can see here we've got a bearish harami. We've been trading up. We come into a resistance level, and there could be a resistance level out here, and we're coming into that resistance level, and we see that bearish harami, and we did trade down after that. And you can see that as we come down here at the bottom, we're also coming into a support level, and we do get a hammer there. So that's kind of interesting. So let's take a look now at a bearish engulfing pattern. So again, we're trading up into that resistance level, and as we trade up into that resistance level, we're looking for confirmation that that resistance level is going to hold, and we get that confirmation by that big red candle on the following day. So in this situation, on the first day, it's a narrow range candle that closes up for the day, and the buyers are still in control of the stock. But because of its narrow range candle and volatility is low, the buyers are not very aggressive in this situation. So the second day is a wide range candle that engulfs the body of the first candle and closes near the bottom of the range, and the sellers have overwhelmed the buyers. So in this case, the supply is now greater than the demand, and the sellers are ready to take control of this stock. So let's see what that looks like in the on a stock chart. So you can see we're coming up into that resistance level here, and we're looking for some kind of indication that this resistance level is going to hold. And you can see we've had some resistance level here in the past, just a little bit. So we come up into this area here, and we get this bearish engulfing candle that completely engulfs the candle of the previous day, and we do trade down for that day. Let's take a look now at another reversal pattern called the hanging man. So a hanging man is a type of a bearish reversal pattern made up of just one candle found in an uptrend. It has a long lower wick and a short body at the top of the candlestick with little or no upper wick. While selling an asset based solely on this candlestick is not really advised, but it can give us an idea that that resistance is going to hold, and we can start looking for some downward action. So let's take a look at what that actually looks like in the marketplace. So you can see here we got a hanging man, so we're coming up into this resistance level, and we come up into that resistance level twice, and we get a hanging man, and we do see that stock start to trade to the downside. Let's take a look at some shooting star candlesticks. Now, shooting star, don't confuse this with a hammer or a hanging man. They almost look similar, but they're upside down. So a shooting star is a bearish candle with a long upper shadow with little or no lower shadow and a small real body near the day's low. So it comes after an uptrend, and said differently, a shooting star is a type of candlestick formation that results when a securities price at some point during the day advances well above the opening price but closes lower. So, you know, we have two types of shooting star candlesticks here. You can see one is a bullish type of a shooting star candlestick, while one is a bearish shooting star candlestick. They're basically meaning the same thing, but this one here on the right, this bearish candlestick, has a little more conviction. So what's going on in this situation? So the stock opened up at this point, and then throughout the day it traded higher, indicated by this upper wick. And then the sellers came in and said, nope, we're not going to let that happen. And they drove that stock all the way back down, and we closed at this point. But on this shooting star, we actually closed higher than we opened. But this indication, this very long wick, lets us know that the sellers did not like that, and they wanted to drive that stock back down. So the candlestick on the right, though, however, is a little more conviction, because the stock opened up at this point and then closed lower. So even though they're very similar in shape, they're very similar in shape. One opened higher and closed lower than the other one, which is this one here, which gives us a little more conviction of what that stock's planning to do. So let's take a look at what that looks like on a stock chart as well. So here you can see that shooting star pattern, which sent that stock lower as it comes into that resistance level. So now I want to show you another bearish reversal pattern called the dark cloud cover. So what's happening in a dark cloud cover? So you can see that this candle here had a nice big day, and we closed up near the top of this candle. And then that following day we opened up even higher at this point, but then we traded lower throughout the day, and we closed in the lower half of the previous candle. So, you know, it gets its name from, you know, it opened up sunny. In fact, it even gapped higher, but then because it traded lower and closed in that lower half, it became basically a dark cloud cover, and that's where it gets its name. Let's take a look at one more pattern that I want to show you, and this is probably the most recognized candlestick out of all the candlesticks that are out there, because they're so readily available. There's so many of them. You can see them in so many places. So that is the Doji. So the Doji, basically what's happening in the Doji is that it represents indecision. So the stock didn't really do anything on the day. It might have traded in a long range, but at the end of the day it opened up right where it closed. So we had the open here, and then the range, the high and the low, and then it closed right back at that same point. So we have different types of dojis. The one on the left would be a dragonfly doji. It's kind of symbolic of a dragonfly. So we opened up at this point, traded down, and then turned around and actually traded right back up to that open price, and we closed right where we opened. So this would be a gravestone doji. Obviously you can see why they come up with the gravestone doji. But we opened up here, we traded higher, and then we traded right back down, and we closed lower. So there's a doji right there. Comes into that support level, and we get a doji, which represents indecision, and then we start to trade up to that upside. So we can see quite a few dojis here. There's one there, and if we just look around, we'll be able to see different dojis. Here's another doji right there. So that shows that indecision. There's another doji there. And there's another one almost a doji right there. We could call that a doji. There's another one here. So these form at market bottoms and market tops. Well, that brings us to the end of our video. I hope you found this video helpful. If you enjoyed it, please give me a like or give me a comment down in the comment section. If you want to learn more about options trading and trading in general, click that subscribe button and the bell icon so that you do not miss out on any future videos. Thank you so much for watching. We'll see you next time.